the nice thing about real estate is it kicks off a paper loss in the form of passive activity losses through the depreciation of the asset. With little single-family homes, you typically can deduct it over 27 long years, the building improvement portion. But with commercial real estate, it's way, way better. Through cost segregation, more accelerated depreciation schedules. A lot of times you've seen deducting the entire third of the asset improvement value in the first year, which could mean 5, 10, 20 times as much that first year than doing a little single-family home.
Welcome back to the Massive Passive Cashflow Podcast. I'm Gary Wilson, your host. I'm so glad to have you back listening to the show. We've got an excellent guest today, Lane Kawaoka. And he's an investor just like me. In fact, what I read about him, guys, I just want to tell you, we're an awful lot alike. He's a lot younger than me, but he's starting off on the right track. I think you want to pay attention today. So be ready to take notes. If you are driving, obviously, please don't take notes. And just remember, we always put show notes in our podcast on our website. Just go to globalinvestoragent.com. Click on, you can find the podcast there, and there's several hundred of them, probably over 400. And you'll find Lane Kawaoka's podcast there as well. So anyways, Lane, first off, man, thank you for joining us. I love what you're doing out there in the world, and I feel really, really blessed to have you on the show,
Yeah. Thanks for having me. Aloha, everybody.
Yeah. Hey, if you wouldn't mind, I'm going to start off with kind of a little bit about you, who you are, because people will connect with that. But tell them how you got started, because most of us grew up wanting to do something else. We didn't grow up saying, I'm going to be a real estate investor, So,
yeah. I mean, today, we've acquired over $2 billion of apartments, and, we've kind of played in the commercial space, but it wasn't too long ago that I bought my first rental property, in 2009 when I was an engineer. That was in my early 20s. And then by 2015, started to, do out-of-state rental properties, started to work with brokers, and do the remote turnkey thing. But in 2016, started my own podcast and investment group and started to buy multifamily apartments. And that was the trajectory where it started to skyrocket. But yeah, it all starts with that first deal, right? That first rental property. And that's the hardest one to get.
Yeah, I agree. Where was that? Was that where you went to school?
Yeah, I went to University of Washington, worked for a couple years, and was always on that linear path to go to school, study hard, invest in the 401k and traditional assets, and buy a house to live in, which I don't necessarily think is the best idea for some people out there. But if people are bad with their finances, probably a good forced piggy bank, of course, right? But yes, bought a house to live in, saved up 80 grand to buy a house in Seattle for, I think it was $350 was the purchase price. And because I was traveling all over for work, I used to work for the railroad back then, and I would manage construction projects out of Montana, Nebraska, Texas. So I was never home. So, a kid in his early 20s back then, it didn't make sense to have this big house to myself. So I started to rent it out. And that was where I got this taste of cash flow and mortgage pay down, appreciation, and, the taxes. Yeah. Tax benefits.
Awesome. It's interesting. My first property I actually bought with my college roommate, and his family was Greek. His father was a Greek immigrant. His mother was first generation, but Socrates was his name. Well, he bought a 4-bedroom rancher and rented out the other 2 rooms to 2 other guys, and their combined rents pretty much paid our costs. And the rest to say is history. Soc's dad taught us how to do all this. And I was 35 years old. I didn't invest for all because I got married and had children and all that. But at 35 years old, I'm thinking, I was not born to be sitting behind a desk anywhere. I hated it. And I wanted the freedom of my time. So I started investing aggressively. I retired when I was 40. But what happened is, the first property was a rancher. The next purchase I made was a pair of fourplexes. So I went right into the multifamily right away. And I'm so glad I did, because it's just numbers. It doesn't matter if it's 2 or 102. The math is still the same. Yeah, it's a lot more work. You've got to pay attention more. There's more to track and measure. But for everybody listening, Lane talks about multifamily. So let's go ahead. Let's do that. Let's talk about the multifamily versus single family. So what should you do? What should they know about that? Why multifamily over single family?
Yeah, I mean, I kind of put this in my book, The Wealth Elevators. There's different floors to the wealth building journey. Mostly I work with accredited investors, so $1 million net worth and greater. But
Hmm.
if you kind of read in my backstory, I started off at the first floor of the wealth elevator as a non-accredited investor, right? I had some student loans, but overall I made a good salary and able
Hmm.
to save 50, 100 grand a year, which I threw all into rental properties those first, 4, 5, 6 years.
Hmm.
Um, and that time, I think if you're still a non-accredited investor, I don't think you really belong in syndicated deals, right? You don't have
Yeah.
the net worth at base to be able to withstand the ups and downs. So what do you do? I think still think you buy little rental properties, right? I mean,
Mhm.
that's the name of the game, and I think a lot of the people out there have a lot of access and deal flow to that world. But there comes a point, and for me, it probably happened around 2015 when I had 11 rental properties. I think
Okay.
four in Birmingham, five in Atlanta, one in Pennsylvania, and another in Pittsburgh or yeah,
Hmm.
Indianapolis. Sorry. So they were all
Okay.
scattered around, and I had professional property management on all of this because I'm working my engineering job out in Seattle, and I had eviction or two every year, and some kind of
Yep.
big catastrophe every quarter, which wasn't a huge deal, but those 11 rental properties gave me maybe like 2 or 3 grand of passive cash flow per month, and most of my clients these days, they're looking more for 10 to 20 thousand dollars of passive cash flow a month, or even
Yeah.
just do the math. If you want 10, you're going to need damn near 30 or 40 of those lower rental properties, and you
Yeah.
increase that exception rate by 3 or 4 times. So it's great when you're getting started, but it's just not scalable, especially when you become an accredited investor. Your net worth gets greater, right? Yeah, you can put these entities in an LLC, and not giving tax or legal advice, anything I say here, but if everybody needs referrals to those types of people, right, you can do it. You can put them in entities, but it's not ironclad legal protection as not being the actual general partner or managing member on the deal.
Yeah.
So for those reasons, that was kind of where naturally I moved up, and that was kind of where I got around other accredited investors, right? And a lot of these accredited investors, they're not at the local real estate club, right? Those are like a lot of house flippers, wholesalers, places where real estate brokers can really like to find those types of clients, those active investors. But the
Right.
purely passive accredited investors, a lot of these guys had the same pedigree as me, where we bought a bunch of rental properties and then scaling up to the bigger deals.
Yeah. Well, I've got so many questions here. So, um, we started out, you got out of university, and if you don't mind sharing, what were you making as an engineer? And, did you keep that job while you were investing until you exceeded your investment income exceeded your job income, or what was your formula for exiting the corporate world and going full time into this?
Yeah, I mean, at the context, I wasn't a very good engineer. I'll say that, right?
Okay.
So I probably made, I was probably around low six figures, right? Just call it 100 grand. But my claim to fame was I was a really frugal saver, and because I was sort of homeless for a few years, right? I just lived off the company dime in corporate housing and hotels, so I was
Mhm.
throwing in like 90, 100 grand every single year to buy more rental properties. And I think that's a key. It's a key indicator. Like most of my clients are saving 50 to 100 thousand dollars a year to put to investments,
Yep.
whether it's stocks, bonds, mutual funds, or alternative assets. I mean, if you put that much in every single year after year, you're going to do very well.
Yeah.
Multiple seven figures there. So that was kind of my, quick step into this world. And of course, getting into the right investment, single family homes, then larger deals kind of got me to,
Mhm.
accredited investor status and beyond. But throughout this whole time, I was kind of a passive investor, right? I had professional property management to do my dirty work for me. And
Mhm.
it wasn't until about 2016 when I started my podcast, started the passive investment community, and it started to, transition to more larger deals. And at
Mhm.
that point, started to general partner on a lot of smaller deals, little 50 units, Class Cs, stepped up to bigger ones. I think in 2020 during the pandemic, that was when we really did a lot of deals at that
Yeah.
point. We really hit our stride. That was when, brokers control deals in the commercial real estate world. It's very different than the
Yeah.
residential world where, um, so that was kind of where we got a lot of, we kind of hit our stride. I think we went over $1 billion of assets that year. And
I,
that at that point, what I started to do was, I was still working my engineering job, I think around 2018. At that point, I think I was already on my fifth or sixth deal. And it just felt a little irresponsible to work my engineering job for 1 or 2 hours a day and then slide to my computer and do my real work, right?
yeah,
So that was kind of the life for quite some time. So I don't know. I guess for people listening, I wouldn't necessarily use me as a model because I'm a general partner who sponsors and operates multifamily apartments. I'm not like a passive investor, right? So
right.
if I was a passive investor, I mean, who knows? Maybe I'd still be rocking and in my
Mm,
corner and, collecting a paycheck and having this stuff built on the side. Who knows?
yeah, yeah. I didn't leave. It was 5 years of really active investing, aggressive investing, and I got to the point. I think I had, I don't know, like 70 something units, and it was exceeding my corporate income, which was pretty good. They kept promoting me. The funny thing is the more investments I had, the more relaxed I was because I didn't. I realized I needed my job less and less. I was making decisions that were actually better corporate decisions because it wasn't about me trying to keep my job or beat the next guy out.
Yeah,
You know,
I noticed that too. The last year, I just
yeah,
didn't care at all. And I just like,
yeah,
I would call meetings, even though people would probably normally push them off 3 or 4 weeks and like, no, we're just gonna do this now, guys, because I don't
yeah,
care. I really don't
yeah,
care. And people enjoyed that, like,
yeah,
um,
yeah. Isn't
and
that
yeah,
funny?
that's, and then also I noticed a lot of my investors that, when they get to that, when they kind of cross over the rainbow, as I call it,
Yeah,
they get to that point where they're going to leave their job, typically what happens is the employer offers them more money, right? So
yeah.
it really is, it truly is, when you start to,
Mhm.
vote with your feet and leave, that's when people start throwing money at you, right? It is a supply and demand thing for sure, and a
Yeah,
negotiated salary.
yeah. Those were comical times, it was sad when I had to actually lay people off one year at Christmas. Well, it was 2002, week of Christmas, something, and the executives are like, what are you guys doing? You're going to kill morale around here because now everybody that you're not laying off is going to be running around updating their resumes, looking for jobs, thinking who's next. That's exactly what happened. And I left. It was with 8 months. I had left that summer. I left. And I'll tell you, this is funny. So I got all my personal belongings on my last day, and I had a dolly from home, to pull my boxes and stuff. It's hot. It's August, and then my eyes undone. I'm sweating. I'm on the street corner. And these two guys walked up and said, "Man, we feel so bad for you. Can we help you get to your car with your stuff? And do you have a resume? Will help you." So what do you mean? He said, "You've got caught up in a layoff." I said, "No." I said, "I just retired. I don't have to work anymore." And I looked at me, and I realized when the words came out of my mouth, how profound that was. I'd literally bought my own freedom. I crossed over the rainbow, you know, and from there was the rest of the is history. But one thing I want to get back to is you mentioned, credit investors and the fact that they're saving 50, 100,000 a year. And I remember what it was like when I got to that point. I really didn't have all the right structures in place, the entity structures to be able to manage and minimize taxes legally. But what can you tell people? I mean, like, how are some of the people, how are they, I hate to use the word avoiding, but legally minimizing, what could be essentially 100,000 or more in taxes every year. I mean, that was what I was looking at. I'm thinking this is crazy. That's more than I made in salary just a few years before. So
Yeah. I mean, we can certainly dig into it. I'm not a CPA, but I try to teach my guys like, look, this stuff isn't rocket science. It's more strategy. Like your CPA's job is to do your taxes for you, not necessarily strategy. And that's where you kind of need to know how these things kind of work. And things do change very
mhm,
slightly every few
mhm,
years. But the nice thing about real estate is it kicks off a paper loss in the form of passive activity losses through the
mhm,
depreciation of the asset. With little single family homes, you typically can deduct it over 27 long years, the building improvement portion. But
mhm,
with commercial real estate, it's way, way better. Through cost segregation, more accelerated depreciation schedules. A lot of times you've seen like deducting the entire like third of the asset improvement value in the first year,
mhm,
which could mean 5, 10, 20 times as much that first year than doing a little single
mhm,
family home per your dollar invested. So, this opens up a huge new tactic for which not a lot of people, little single family home renters, owners know about, right? You can get
Yeah.
this huge amount of, investing 100 grand, you may get $50,000 of passive losses that first year. It'll more than offset your $4,500 of passive income, right? And you'd
Hmm.
still be left over with about $45,000 of suspended passive losses that you can use to offset future passive income. Not going to get super into real estate professional status. Some people are
Right.
able to use the passive losses to offset their other income. I
Hmm.
would say, it's more of a personal situation, and more than willing to kind of walk with this people on the phone, since I'm not a certified financial planner and I'm not
Yeah.
allowed to give financial advice and portfolio analysis. Um, and I don't sell
Yeah.
marketable securities. So like,
Yeah.
like those
I
guys,
know.
but
Yeah.
yeah, like I think that's where I found myself in 2016,
Mhm.
and started interacting with accredited investors. And these are all guys, financial hackers like myself, doing this stuff, investing in alternative investments directly with the sponsor operator, diversifying their portfolio in dozens of these types of individual deals. And then the taxes, right? I mean, now you open up into the world of oil and gas investing with intangible drilling costs there. Solar projects is another tool. Used to be land conservation easements, but nobody does that anymore because of higher scrutiny these days. But these are just throwing it out there as like these are the things that nobody really talks about. And then I got into these rooms of these people and started to distill and just shut my mouth and listen. Like, what are the best practices that keep routinely coming up? And what I discovered and what I talk about in my book, The Wealth Elevator, is for accredited investors, you invest directly into these larger commercial assets. You extract out the passive losses to do all these cool things on your taxes and the things I've been mentioning. You run it through an infinite banking plan. And that's kind of the trifecta. That's the super powerful, like, they all kind of work in conjunction. And it's very powerful to getting you accelerating to financial freedom a lot quicker than the traditional way. But it's not something that the average guy could do, and that's what frustrated me. But what frustrated me was like everybody's doing the opposite, right? It's very counterintuitive to what everybody's taught.
Hey there, did you know you can join a free real estate mastermind session every Monday night? It's called Monday Night Live, and it kicks off at 7 p.m. Eastern. I'm Gary Wilson, and every week I host this live class, joined by investor agents from across the country and around the world. And here's the best part: no selling, no recruiting, just pure, actionable real estate education. Every Monday, we cover everything from the basics to advanced strategies. We even bring in expert guests once or twice a month. Topics like how to buy property using crypto, how AI is reshaping the real estate landscape, what the metaverse and blockchain mean for real estate deals today. Whether you're a new investor or a seasoned pro, you'll walk away with real value, and you'll have the chance to ask questions live, connect with others, and expand your network. Sound good? Then head over to realestatewithgarywilson.com. Click the Resources tab, select Monday Night Live, and you'll find recent replays plus a full schedule. You can register for any upcoming session, even weeks in advance. And if you're watching this on social media, just check the video description for the direct registration link. I'll see you Monday night. Bring your questions, your notepad, and your drive to grow. I look forward to connecting with you.
I agree. By the way, everybody, I probably could say this every time. I don't always remember, but I'm not an attorney and I'm not an accountant and I'm not a tax advisor. These are all based on our own, personal experiences and those of our clients. And always seek the advice of your professionals, attorneys, accountants, and financial planners.
That is
Um,
correct. That is
yeah.
correct. I will echo that, but I will also add a
Mhm.
lot of those guys are stuck in a job working forever
Oh,
and they
yeah.
haven't figured this stuff on their own. So what we'll probably see from a lot of our clients is at least 80% of them will change their
Yeah.
set of professionals pretty quickly.
I did. And you know what I did actually? I actually stumbled across him accidentally. I went to go see one tax accountant as I started accumulating properties and I could no longer use the guy I was using. And the guy I went to visit, he wasn't back to his office yet. He was late. I didn't know that because this was before we had, cell phones all over the place. And I turned around to get back in my car, looked across the street, and there was another tax accountant. So I went over there, introduced myself, and I told him what I was doing. And I said, "Are you familiar with investor properties?" He said, "Not only am I familiar with them, I actually own them myself." And bingo, he's now in his 80s. He's been my tax accountant now for it'll be 30 years next year. You know, it's amazing. Um, But in any case, I want to go back to you mentioned syndication earlier in the wealth elevator framework. But let's talk about syndications for a minute and how can that really help people scale much more quickly than just doing the old outright buying a duplex, buying a fourplex, that type of thing. You can expand on that a little bit. I think that would really help a lot of people.
Yeah, I mean, let's face it today, it's like you can't buy $80,000 property and cash flow at $400 a month these days. Prices are up, taxes, insurance is like double what it was a decade ago. And to get alpha, you need to do value add, right? So that opens up, buying little single family homes, flipping them, but your entire income stream is cut off while the development is under progress. And the reason why we've kind of moved away from the residential world and into the more residential commercial world is you buy anything under $5 million, under 20 or 30 units, it's extremely competitive. Everybody flips houses or can.
Yeah.
Which is, I mean, also why I think a lot of people listening are brokers, right? Everybody thinks they can, so you can go sell them on a house and make your commission off of these suckers. Right. But in reality, there are a lot more higher quality investments and less competition, especially when you get around like 50 to 200, 300 units, right? Buying these types of apartment complexes. I say 50 because you want to get higher than that. Really, you want to get to 100 units because at 50, 60, you can have a leasing agent on staff all the time instead of a residential property manager, which we all know they're just the guys who can't sell houses, right? So they have to be the grunt worker and manage it. But most of their day is spent running around town, right? Whereas commercial real estate, property management, they're in the seat at all times, and the really kind of utilization rate in the seat is pretty high. The biggest thing also is having maintenance on salary, right? Like I think we had we just had a big cold front in Texas and the Midwest recently. Everybody in Texas has PTSD since the 4 or 5 years ago when they had that ice storm. We went through that. We survived. Our pipes broke too, but we could fix them with our in-house team, right? Where everybody, all the little landlords are running around for Mario and Luigi to fix their stuff, and that's just not a good situation. Plus you're paying the exorbitant fees when you're a small-time landlord there too. But a couple of big reasons why to move into more commercial quality assets is better. And then now you have a general partner sponsor kind of ramrodding the business plan, renovating units. Typically what we'll do is we'll look for projects that has a little bit of a depressed older feel to it, and you can infuse maybe $5,000 to $10,000 of renovations into each unit, which to do anything in a single family home is going to cost you 50, 200 grand. Right, to do anything substantial. But the cool thing about apartments is like rinse, wash, repeat. You just keep doing it. New flooring, new appliances, new paint job, done. That's it. And then some exterior improvements, paint job, playground equipment, new clubhouse is typically a big thing, right? A lot of dollars will go in there. But as tenants are naturally moving out, you're not kicking out tenants. Well, you are the deadbeats one, the one that you don't want in the community. But you're going through there slowly, and you're just kind of knocking out these unit renovations and bumping the rents up slightly. And the cool thing about commercial real estate is it's not evaluated off comparable sales like residential properties, right? As we all know, what the property sold down the street has a huge impact on what your property sells for. In commercial real estate, it's a lot more numbers driven based on your net operating income. Essentially, how much profit does the asset produce? You get paid a certain multiple of that. So if you can improve the income or decrease the expenses to make more profit on that asset, you get rewarded sort of instantaneously on there, even if you don't renovate all the units, right? So it's a very liquid kind of world where, even if you don't take the business plan to renovate 100 of the units, you could sell at any point. This is why it's the investment of choice of institutions, family offices, more sophisticated investors. The only downside is you got to, average accredited investor with $5 million net worth can't go buy an average $50 million property, right? Unless you go in with other people, maybe a 50, 100 people, and everybody throws in 50, 100 grand. That's the way that you can pull capital together to get access to these more institutional quality investments.
Yeah. Yeah. I love what you're doing. I love the way you're explaining this too for people. Um, I know for me, I don't actually buy properties directly anymore. I haven't done that for a while. I used to own, hundreds of them, but I moved into fractional ownership because I can get in and out. Nobody knows who I am, and I get to take advantage of it. It actually is. It's more direct than going through like a REIT or some type of closed-end mutual fund. We've done those too. We actually created our own one time. But with the syndication, the benefit there is the pooling of the funds. And generally, everybody's being vetted. It's like a pool of people that have a lot in common. That's why I like it. I really appreciate you explaining that. But I want to go back to the wealth elevator. You mentioned that from your book. So if you could give the title of your book again, and then talk about the wealth elevator going from like 1 million to 10 million net worth. The 5 stage room. Just expand on that a little bit if you don't mind.
Yeah. So the wealth elevator, it's mainly for accredited investors. So the construct that I use in the book, and there's a little pull-out table with a table because I'm an engineer, of course. You've got these different floors, right? So the basement floor is, the book's written for Dave Ramsey, Susie Orman, right? People in debt, right? We just kind of lightly mention, and these are the people who make less than $50,000 a year, and not much net worth. If you're in the basement, don't buy the book, right? When I first started, I was in that first floor of the wealth elevator, not yet to $1 million net worth, at a good salary, and it just took me a while from 2009 to 2015 to acquire little rental properties. I think at that point, that's when I became more on the second floor of the wealth elevator, which is where you're hitting accredited investor status, $1 million net worth and greater. And this is kind of where you're getting more involved in these direct access deals, where you're not accessing it through the secondary market. Secondary market is, as we all know in this world, sloppy seconds in terms of like liens in a way, right? It's when you're going through the Wall Street channels to buy the direct assets. So like a REIT is a secondary access, right? You're buying the same apartments we are, but with a whole bunch more middlemen, right? How else do they build these big corporate buildings and CEO salaries? So what you're doing is, as you're ascending the wealth elevator, right? You're kind of, you need to buy little rental properties to get to that second floor, but then you kind of trade them in, and then you're kind of, the world opens up more to these other tax strategies and different asset classes, right? Like multifamily is something I was very accustomed to because coming from single family home rentals, and I lived in apartments going to college. So I think it's a great starting point for a lot of people, but you start to realize very quickly that there's all these other asset classes out there, like self-storage, mobile home parks, which I'm not a huge fan of those two for particularly reasons these days, especially within the market cycle. But now there's also buying businesses, right? And then, then the world opens up, and then there's more asymmetric plays with, angel investments, that type of world. And so you as an investor, it's kind of like, the world is your oyster, and it's also, can be a little bit dangerous, right? There are landmines out there in terms of people. So it's, it's not for everybody. That's for sure. I still think most people should just stick to their 60-40 stocks, mutual funds portfolio. But, this alternative investment portfolio, if you can surround yourself with the right people, this is why I put on a retreat every year in Hawaii. We have our own ecosystem of purely passive accredited investors. It's good to arm yourself with other people and kind of co-source due diligence with each other and just build relationships mainly with other high net worth accredited investors with similar value sets, similar ages. We're all kind of on this journey together, right? I mean, nobody's really a special snowflake, right? So if people are an accredited investor, we can jump on a call, but I'll be honest, like after doing this several thousand times, like people, everybody's going up the same elevator at the end of the day. Nobody's really a special snowflake. Most people are first generation multimillionaires. They're the ones who diligently built their net worth up. And, it's kind of easy to get to a certain level, that $4 to $5 million net worth by the end of your timeline. But some of the software skills of, how do you transfer the wealth to your kids and then your grandkids? That's kind of, I think, where you really need an ecosystem around you.
Yeah, I agree. Actually, that's a great segue into one of the things I've read about that you mentioned is, community and legacy wealth, the Hui mindset. Would you mind Just kind of give us from your own experience with family and friends and colleagues, what does that mean to people? Because I think it's really important. The it's a way of it's really a way of life is what it is, particularly when it comes to business and money. But in general, it's a great way for people to live. I'd love them to hear this if you don't mind sharing.
Yeah. And I'll self-admit, like, everything I talk about in the book is experience shares, things that I've learned. It's kind of a
Mm-hmm.
mantra of entrepreneurs organization.
Mm-hmm.
You never spout other people's advice. But I will say in this circumstance, I have young kids, and most of my investors that come, especially that come to retreats, are like in their 50s. So I'm actually vicariously living through them and having them mess it up
Yeah.
for me. But what I
Mm-hmm.
normally see is, if you're a diligent saver, it's just saving 25 grand in your 30s and 40s, and you invest in the right place and you mitigate your taxes pretty well with alternate investments, your net worth typically goes to $3 or $4 million before age 60. And so this is the situation that a lot of these guys are in. And from a family standpoint, their kids, if you're listening, your kids, if you're younger, your kids you'll probably pay for them to go to the best colleges, schools. Let's be honest,
Mm-hmm.
right? So
Yeah.
they're going to likely become doctors, lawyers, engineers, noble professions in this world. Who
Mm-hmm.
knows what happens with AI, right? Of course, but I probably still bet on those as being probably more
Yeah.
important than just having no technical knowledge. But I digress. So the problem, and then you're also having a lot of influence over them, right? Like I'm kind of, right over my kids all day long, right? Because I don't have a traditional job. And,
Mm-hmm.
but the problem is that third generation, right? If you don't teach your kids how to invest and stop trading time for money, they'll have everything given to them and they won't know how to create wealth. And there's
Yeah.
this transition that we talk about in the third floor of the wealth elevators. You've hit a certain end game number of $4 to $5 million. Why $4 to $5 million? Because you could probably put your money in life insurance or T-bills and just chill at that point. Probably
Mm-hmm.
produce at least $20,000 of passive income at that point, and not even investing in rental properties, etc. You don't need that stuff at that point, at that net worth level. But
Mm-hmm.
the idea is there's a realization that you need to stop trading your time for money, whether you're a doctor, an engineer, a lawyer, or you run your own business. And we all know the Kiyosaki 4 quadrant model, right? Like you may be
Yeah.
that person who is just working in your own churn, right? You're a
Yeah.
business owner, but you're trading time for money. Let's be honest, right?
Right.
So the idea is like at some point, and it's not a black and white thing, it's kind of a smoother transition, but you get to a point where you realize I need to stop trading my time for money and I have enough money and I need to switch to being a good steward of that money and being a good investor. And at that point, you've kind of adopted the mindset of a true family office.
Yeah.
Family office is, most time they're known to have 50, $100 million of net worth or greater. But to me, it's more the mindset of like, we need to be good stewards of the money and invest it and diversify it in many, many, many places. So this
Right.
net worth doesn't just decay. For most people out there, even in my group, right? Most people just aspire to $5, $10 million net worth and they just give it to their kids and their kids will have a kid or two. So $10 million to 8 grandchildren goes real quick and it just dissipates. And that's cool because then none of the grandchildren or the cousins or the sons or daughters will fight. And that's very strategic to do it that way.
Mm-hmm.
But some people latch upon this idea. Personally, this is me, where we're going to grow this thing and become that next great American family office story that ascends to 50, 100 plus, right? But to do that, you need to have the realization that you no longer are trading time for money and you are an investor and you need deal flow and you need a network of other accredited investors around you.
Yeah. Yeah. I tell you what, very extremely valuable information. And I appreciate that. So do you have syndications that people listening can participate in as long as they're accredited? I mean, how can people get a hold of you? And also, what's the title of the book again? What's the title of the book? Is that the
the Wealth Elevator
Wealth
on
Elevator?
Amazon. If people buy it and leave a review, just shoot us a screenshot of it and email team@thewealthelevator.com. We'll hook you up with the MP3 and the PDF copy. I
Awesome.
noticed that's a great way you can slide into ChatGPT and ask it more personal questions. But yeah, if you're an accredited investor, I mean, the way we do it is we prefer to build a real relationship with you. There are ups and downs. People haven't felt the lumps in commercial real estate the last several years. They're lying, or they're brand newbies and haven't felt the pain and been in it long enough. We've been kind of in it almost a decade now. So, but yeah, I would prefer to work with people I know and like, right? And we have similar values. So,
that's awesome. How about a website? I read the book, The Wealth Elevator is the book, guys listening. But a website, anybody can they go to a website to check things out, or?
Yeah, they can go to thewealthelevator.com/start. Actually, thewealthelevator.com/syndication if you're looking to invest in syndications. A lot of new information there. Back in the day when I first started my podcast and doing that, I would kind of teach people how to buy little rental properties remotely.
Yeah.
So if you're not an accredited investor, I would say start there. A lot of that's on my website for free, right? Kind of a give back to the world. Or as I say, once you get to a certain point, send the wealth elevator back down for others and help out others in the ecosystem.
Oh, I love that. Is the podcast also the same name, Wealth Elevator Podcast?
Yep.
Okay. I'll write that down. So we'll put all this in the show notes. Everybody listening here, I'm sure you feel the same way. This has probably been one of my favorite podcasts we've done in a long, long time. I mean, if you're watching in recorded mode, you get to see Lane like I do. But if you're not, you're listening to just audible. You don't get to see this. And I'm telling you, the energy is palatable. So I suggest you go to YouTube, go to our, get the globalinvestoragent.com and get the full recording so you can actually see Lane, and hear him talk. But Lane, this has been awesome. I'll put a plug in for myself. If you'd like to, I would love to be a guest on your podcast too and return the favor. And I've done a lot, from little teeny flips up to giant, $800 million development deals and everywhere in between. But my heart is with people really trying. They've done a little bit. They've figured out how to get out of the day job. They got some money coming in, but they're still working at it. Like you said, they're trading their time for money. And it's just a little thin layer of cellophane between them and where they want to be. And lots of people have done it. I needed help. I didn't get where I'm at myself. I definitely had help. And this whole thing is about, the psychology of a rising tide lifts all ships. So help somebody else. If you're feeling down or you want to help yourself, well, the best things you can do is help somebody else. It just opens up the channel for you to receive help yourself. I can't explain the science behind it. Maybe the who we can, but I'm just a beneficiary of it. I know that it works, and I hope everybody listening benefits the same way. And check out Lane. Go to wealthelevator.com/syndication if you're interested in participating in one of the syndications. Listen to the podcast, okay? And more importantly, go get the book. I don't want to share right now. I've got over 3,000 books in this house. Every room has bookshelves, and I still collect them. I'm a nerd, and I'm an addict of learning. And you learn, the more you learn how much there is to learn. So, in any case, Lane, you did an awesome job, man. Thank you very much. And for everybody listening, take care of yourselves. God bless you and all your loved ones. And we will see you in the next Massive Passive Cashflow Podcast.
Thanks for listening to this episode of Massive Passive Cashflow. Be sure to go to realestatewithgarywilson.com to join our community and start building wealth today.